Right now, if you pull up the silver chart, it isn't just a market. It's a warning sign. For over 15 years, JP Morgan Chase has dominated the silver market, systematically suppressing prices through massive short positions and paper contracts with little physical backing. This isn't speculation or a theory, it's documented in trading data, derivative positions, and registered silver inventories. For retail investors, the market has seemed stable at times. But behind the curtain, the largest bank in the United States has been controlling the flow, keeping silver artificially low while accumulating real metal quietly in the background. What's happening now is a seismic shift. JP Morgan is no longer holding short positions. They are exiting, flipping long, and signaling to the market that the suppression era is ending. The implication is simple. The dam is about to break, and the silver price is poised for an unprecedented surge. Physical silver is disappearing from the COMEX vaults at alarming rates. Registered silver, which represents the metal available for delivery, has dropped from over 150 million ounces to less than 40 million ounces, a 73% decline. Meanwhile, open interest in paper contracts remains high, creating a ratio of roughly 22.5:1 between paper silver and physical supply. In practical terms, even a small demand surge for physical delivery could collapse the paper market instantly. This isn't hypothetical, it's happening in real time. Investors who ignore this are at risk of being caught on the wrong side of history. The math alone makes the potential upside staggering, with the imbalance between supply and demand creating the perfect storm for a short squeeze that could push silver far beyond $100, $200, or even $400 per ounce. Regulatory shifts under Basel III are also forcing banks like JP Morgan to rethink their positions. Previously, paper contracts could count as Tier 1 assets on a bank's balance sheet. But the new rules require physical metal to meet capital requirements. Shorting silver is no longer cost-free, it carries balance sheet risk. For institutions, the decision is clear. Either cover short positions and secure physical metal, or face mounting costs and potential collapse. JP Morgan is choosing the former, which is why their buying activity is accelerating and why this moment is historic. Every transaction is a signal that the manipulation era is ending and the market is resetting toward a real, physical-based price. This setup mirrors some of the most dramatic commodity squeezes in history, where limited supply meets concentrated short positions. Unlike past years, this is compounded by industrial demand. Silver is integral to solar panels, electric vehicles, and high-speed electronics, meaning the underlying consumption continues to grow while supply remains flat. China's aggressive accumulation of physical silver adds another layer, locking up metal and creating scarcity for Western investors. The stage is set for a cascade effect, where every institution that remains short faces mounting pressure, triggering covering that pushes the price higher, a self-reinforcing loop. As this section closes, it's important to internalize the context. JP Morgan is flipping, inventories are collapsing, industrial demand is growing, and regulatory pressures are aligning. This is the first signal in a chain of events that will define the next wave in the silver market. Understanding this foundation is critical because everything that follows, from gamma flips in options to potential unobtainium scenarios, stems from these structural shifts. If you're ready, the next section will dive into the mechanics of the short squeeze, the role of derivatives, and how these factors will directly impact price action, connecting naturally from the context laid out here. Now that we understand the context, the collapsing inventories, JP Morgan's shift from short to long, and the mounting industrial demand, the next piece of the puzzle is how this triggers a short squeeze and propels silver prices skyward. A short squeeze happens when institutions holding massive short positions are forced to buy back contracts to cover losses. And when the supply is limited, every purchase pushes the price higher, creating a self-reinforcing loop. In silver's case, the scenario is unprecedented. The COMEX paper market is 22.5 times larger than the physical supply. If just a fraction of shorts are forced to cover, the available metal vanishes instantly, leaving no liquidity cushion. Derivatives amplify this effect. Hundreds of thousands of silver call options exist at strike prices ranging from $35 to $100 and beyond. Option sellers, including banks and market makers, hedge their positions by buying futures as the underlying asset approaches the strike price. This is the gamma flip, a feedback loop where hedging activity drives the price higher, which triggers more hedging, which pushes the price even higher. In past events like GameStop in 2021 or Volkswagen in 2008, gamma flips created parabolic price movements in a matter of days. With silver, the structural imbalance is far more extreme because the short interest is concentrated, supply is tight, and demand is both industrial and speculative. The stage is set for a historic gamma-driven squeeze. JP Morgan's exit from the short side is pivotal. For over a decade, they acted as the suppressor, selling paper contracts to keep silver low. Now, as they accumulate physical metal, they are effectively removing the largest obstacle to a price explosion. The squeeze won't be gradual, it will be mechanical. Algorithms and risk models used by banks and hedge funds are programmed to manage maximum loss thresholds. When the price breaches those thresholds, automatic covering occurs. Multiple institutions being forced to cover simultaneously creates a cascade effect. The very system designed to manage risk now accelerates the price surge. The V-shock scenario, where automated liquidation triggers a chain reaction, will push silver into parabolic territory almost instantly. Meanwhile, physical premiums are already signaling scarcity. Dealers reporting $8 to $15 premiums above spot reflect the growing difficulty of sourcing physical silver. As delivery times stretch and inventory runs low, industrial buyers and investors scramble to secure metal, which further accelerates the squeeze. Unlike previous market manipulations, this one intersects with real-world industrial demand, from EV production to solar panels, ensuring that every ounce absorbed from the market has tangible economic consequences. By the end of this section, the takeaway is clear: the short squeeze is not a possibility. It is an inevitability. The combination of collapsing inventories, concentrated short positions, derivative hedging, gamma flips, and industrial demand guarantees upward pressure on price. The only unknown is timing, but the mechanics themselves make it unstoppable once initiated. The next section will dive into the global geopolitical and regulatory angles, including Basel III, China's accumulation, and how these factors magnify the squeeze, connecting directly to the structural dynamics explained here. The market dynamics unfolding in silver are not just about JP Morgan AS strategic exit from short positions. They are part of a much larger global shift that has been quietly building over years. Basel III regulations fully implemented in Europe in 2021 and now rolling out worldwide fundamentally changed how banks can treat precious metals on their balance sheets. And suddenly paper silver is no longer considered equivalent to physical metal, forcing banks to either back their positions with real silver or abandon them entirely. This regulatory pressure directly influences the moves we are seeing, as institutions are compelled to hold physical metal, which aligns perfectly with the reduction of shorts observed on the COMEX. Meanwhile, China is quietly consolidating its control over physical silver, aggressively buying domestic mine production and importing from Peru and Mexico, while largely restricting exports, effectively hoarding tangible assets and leaving the West with a paper-dominated market that becomes increasingly fragile with each passing day. Industrial demand compounds this shortage because silver is essential for solar panels, electric vehicles, and AI data centers, and with global renewable energy mandates expanding rapidly, industrial users compete directly with investors for a shrinking pool of deliverable metal, sending premiums higher and reinforcing the squeeze mechanics already in motion. Historical government interventions in precious metals show us that controlling tangible resources has always been central to economic power. And while Roosevelt and Nixon acted decades ago today, the situation is more nuanced, with central banks aware of supply constraints but unable or unwilling to directly intervene in physical markets, allowing structural imbalances to intensify naturally. This creates an environment in which JP Morgan AS strategic flip from short to long is not just opportunistic trading. It is a rational response to a system that is increasingly incapable of supporting paper claims against dwindling physical inventories. As registered silver inventories on COMEX fall below 40 million ounces, far short of annual industrial and investment demand, the imbalance between paper contracts and physical supply grows extreme, and every new demand shock has the potential to accelerate the squeeze exponentially. The interplay of regulatory constraints, physical accumulation by sovereign and industrial players, and the ongoing short covering by large institutions establishes the conditions for a historically unprecedented price movement. And the convergence of these factors ensures that the West, reliant on leveraged paper positions, is at a severe disadvantage compared to those holding tangible silver primarily in China. When the gamma flip from options hedging intersects with these supply, demand, and geopolitical pressures, the result is not a simple price rally, but a systemic market revaluation, a transfer of wealth and control over a critical industrial and monetary resource. and the first real opportunity in decades for retail and institutional participants who recognize the trajectory to secure their position in physical metal before the paper market loses all relevance. The forces in play are interconnected. Basel III makes shorting costly. JP Morgan exits shorts. China accumulates, industrial demand rises, and registered inventory collapses, forming a self-reinforcing chain that will culminate in a dramatic repricing of silver that cannot be ignored. As the COMEX inventory continues to shrink and JP Morgan's position flips from short to long, the mechanics of the silver market are entering a phase that could redefine historical price norms, and the $400 target is no longer speculation, but a mathematically supported scenario based on the convergence of supply, demand, and institutional positioning. The registered silver inventory has dropped below critical thresholds, and with only around 40 million ounces physically available against 900 million ounces of paper contracts, the leverage ratio is astronomical, leaving the system vulnerable to any significant delivery demand even from a fraction of holders. Each new retail or institutional purchase erodes the available physical metal, and with industrial demand already consuming hundreds of millions of ounces annually for solar EVs and AI applications, the surplus is evaporating at an unprecedented pace, creating the conditions for an unstoppable short squeeze. The gamma flip in options markets amplifies this effect because as silver breaks key strike prices on calls, market makers are forced to hedge by buying futures, which drives prices higher, creating a feedback loop that accelerates the squeeze even further. JP Morgan, understanding the V-shock risk embedded in algorithmic trading models across banks and hedge funds, has preemptively positioned itself to benefit from the cascade, and their actions signal to the market that this is no longer a quiet accumulation, but the opening of a major price event. Historical parallels from Volkswagen in 2008, GameStop in 2021, and nickel in 2022 illustrate that concentrated short positions combined with limited supply invariably result in explosive upward movements, and silver now meets every condition for such an event on a global scale. The rehypothecation problem adds another layer of urgency, as much of the COMEX's physical silver may be pledged multiple times, meaning the actual deliverable supply could be far less than reported, compounding scarcity and making the paper price increasingly meaningless in comparison to the physical market. Industrial users aware of potential shortages will bid aggressively, driving premiums far above current spot prices, and when supply is exhausted, the only metric that will determine silver's value is what buyers are willing to pay, which explains why projections toward $400 are not hyperbole but a rational outcome under current market conditions. The geopolitical dimension intensifies the pressure, as China's stockpiling secures their industrial and strategic advantage while leaving the West exposed to a paper-dominated market, creating a potential wealth transfer when the physical shortage becomes undeniable. Meanwhile, the Fed's repo market policies intersect with these forces, because physical metal is required for collateral in short-term liquidity operations, further incentivizing banks to acquire tangible silver before the system breaks, reinforcing upward pressure on prices. Every institution, from hedge funds to major banks, now faces the same reality. They either cover short positions or risk catastrophic losses if the COMEX cannot deliver, and each forced purchase accelerates the cycle. Retail investors who understand the setup have a historic opportunity to acquire physical metal before the full-blown squeeze, as waiting for dips or pullbacks may result in missed entry points and sky-high premiums. The interplay of regulatory pressure, industrial demand, geopolitical accumulation, rehypothecation, and options-driven gamma flips all converge into a single powerful outcome. The suppression that held silver down for 15 years is ending, and the market is on the cusp of a systemic repricing that could push the metal to levels previously thought impossible, validating JP Morgan's decision to flip and creating a once-in-a-generation opportunity for those holding tangible silver. As the short squeeze gears up and the COMEX faces dwindling physical silver, the market is entering its final act, and the timing for action is now. The convergence of factors that were discussed, JP Morgan's flip from short to long, the collapsing registered inventory, industrial demand outpacing production, rehypothecation reducing actual deliverable silver, and the gamma flips in the options market, creates a scenario where every participant must understand that the traditional rules of trading are being rewritten. Those who hesitate, waiting for confirmation or for a dip, risk entering the market when premiums have exploded and dealers are sold out, effectively pricing out all but the most committed buyers. Physical silver is the key, and the lessons of history show that holding paper or relying on brokers and vaults will not protect against systemic failure. The parallels with past market manipulations from the Roosevelt gold confiscation in 1933 to the $50 silver rally of 1980 demonstrate that when supply collapses and demand becomes insatiable, the only measure of value is what can be physically possessed. Every ounce of silver purchased now removes it from an already strained system, accelerating the path to a price that reflects true scarcity, potentially exceeding $400 per ounce as industrial users, investors, and institutions compete for the same limited metal. The geopolitical angle cannot be ignored. China's continued accumulation guarantees that any physical shortages will disproportionately affect the West, and the flow of wealth may shift to those holding tangible assets, reinforcing the urgency to secure metal before the squeeze fully materializes. The V-shock and gamma feedback loops will act with mechanical precision, forcing leveraged shorts to cover at accelerating rates and amplifying upward price momentum. Regulatory changes under Basel III further tighten the noose on banks holding short positions, increasing the cost of suppression and leaving institutions with little choice but to buy physical silver to balance their books, creating a self-reinforcing cycle that ensures the squeeze will continue until supply and demand finally find equilibrium. For individual investors, this is the most critical takeaway. Owning physical silver is no longer optional, it is essential. Silver eagles, bars, or other allocated products that provide tangible possession should be acquired immediately, stored securely, and separated from third-party custody to avoid counterparty risk. Monitoring indicators such as COMEX registered inventory levels, physical premiums, and CFTC reports will provide ongoing confirmation of the squeeze, but waiting for these signals may be too late, as the market reacts faster than most can anticipate. The role of retail investors, collectively, is to amplify awareness, share intelligence, and act decisively, because institutional players are already executing strategies that will leave latecomers exposed. In the final analysis, the silver market is at a turning point where historical suppression has ended, and the combination of scarcity, industrial demand, institutional positioning, regulatory pressure, and algorithmic market mechanics points toward an inevitable repricing. For those who act now, the opportunity is once in a generation, offering both protection against fiat currency devaluation and the potential for unprecedented gains. The message is clear: the system is fragile, the shortage is real, the squeeze is imminent, and holding physical silver is the only reliable strategy to survive and profit from the historic market transition that is unfolding in real time.